Yeah, that's why you got to always manage your risk. PLBY revenue of 39.4 million versus 68.5 million year over year. Just incredible. Actually, I'm not going to talk about stocks till I do the disclosure. You guys can hear me, right? Or should I say, good afternoon, everybody? There we go. There we go. I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All trades placed by me are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure is pretty much the same, except I added on a long in QS. Yeah, anyway, PLBY just came out with earnings. Up 7% today, big day. But look at this daily chart. There's so many companies out there that they just said, hey, let's de-SPAC it, or hey, let's have an IPO of just complete and utter garbage during that bubble because they knew they could. So it was good money for everybody, good money for the insiders in the company, good money for the investment banks, so why not? Yep, so Playboy here, PLBY. What did I just say? Like 30 million in revenue, 39.4 million revenue. Heck of a company. Yet was able to go public in 2021, and I think it was a SPAC, right? I think that they de-SPACed this thing. I don't fully remember. And they ripped it to 63. Now it's 97 cents. 97 cents probably on the way to zero. But that's what was going on there. And what I was just saying was, like, imagine you were like, this is ridiculous that this company is public. It's at $25 a share. You know what? I'm going to go ahead and short some. Well, then it's at 63. What are you doing? Doubling down? Don't frown, average down, or did your account entirely blow up by that point because you were trying to short a worthless company that they just squeezed the heck out of, like 600% before it completely and utterly died? And there's just so many examples of this too, from like late 2020, early 2021. So it always serves as a good reminder, even more recently when it's felt like maybe we're in a little bit of an AI bubble or whatever, and you could make the argument that certain parts of the market maybe are in a bubble. This bubble, if you even want to call it that, is nothing like what we saw end of 2020, early 2021. I've never seen anything like that in my entire trading career, what we saw back in that period of time. It was just a really, really wild time. And honestly, in some ways, it was difficult for anyone that's rational. Because again, if you're rational, you're looking at Playboy at 25, and you're like, this makes absolutely no sense. Let me short. And then you could easily not have risk management, because when it's at 27 and you should be stopping yourself out, you say, well, this thing's still worth zero, and now it's an even higher price, so how about I average down? And again, by the time it's at 63, you could have completely blown up your account. And just remember, there were so many names like that. There were a few that I got run over on to the short side back then, because I was like, this just doesn't make any sense. These prices are crazy. Like, I need to get on the short side of the market, and it was just very hard. Even if the ideas are obviously right, this thing's at 97 cents now. That's why execution is so important, game planning is so important, and risk management is so important. It's really the name of the game. It's not just having the good idea. Because you know what? It was a great idea to short Playboy at $25. It was a fantastic idea. Look at that. It's worth 97 cents now. But in any of these squeezes, you're getting just totally ripped apart. Roku, at least. And yeah, there were also more real companies that had, crazy moves. I mean, Roku, almost a $500 stock. But at least this is a real company, At least this has got earnings and revenue and management and tons of employees. How many employees does Playboy have? I'd love to know the answer to that. Does Finviz tell you that? Because I remember looking at that iBio this morning that we were potentially trading. It's got 26 employees, and I was like, that's interesting. What is it? PLBY? How many employees do they have? I'm genuinely curious. Over 1,000 according to Finviz. Way more than I would have expected. I don't think that they count their models as employees. All right, let me move on to talking about a different stock before I get myself in trouble. Let's jump into the bulk of our meeting here. The SPYs are up 0.9%. The Qs are up 0.4%, and here's the real winner. IWM here is up. I thought it was 2.7. Am I in a bad print right now? Give me a print. Give me a print. Whatever. 2.3, 2.7%. Huge day for the Russell. Real leadership from the Russell. So the question is this the trend continuation that we were looking for? Yesterday I was looking for trend continuation. I thought, 3 days down into the ADMA, this is where the market should pivot. This is where we should be able to get some sort of continuation. And we didn't get that. We gapped up yesterday. We did nothing. We sold off into the close. We said it's probably related to the pension rebalance, which I think we saw this morning is $32 billion, if that's what we confirmed. And that's probably what it's related to. It's not allowing this market to get any legs. And then today we were able to boost higher, and that doesn't surprise me. What we talked about in the morning meeting, granted it was all into the close, but the information that we had in the morning meeting is that we've got a market where you still have this, big pension rebalance selling into the end of the quarter, but it's being countered by heavy positive gamma. I think the number there is 7 billion, which is a really big number. So that creates some insulation. That creates kind of an underlying bid into this market, into those down moves that can absorb the selling that comes from the pension rebalancing. And the kind of scenarios that we laid out this morning, were basically, there's a good probability of just range-bound action into the end of the quarter here, where you've got the pension rebalance selling being offset by the gamma in the market, like I was saying, insulating things. But beyond that, the risk is to the upside, because the trend is your friend. And I want to pull up Pat's note from this morning to reiterate what we discussed, because I think that it came through. So right in here, gamma positioning. Goldman Sachs models the street long $7 billion of gamma around current levels. And then here's the important line that I highlighted twice in the morning meeting. With length fading as spot moves higher, should be freer to move to the upside, while the long gamma, whatever, that's all I need to read. And then finally this line here, right? This should counteract the quarter end sell pressure from pensions. So basically, like I'm saying, good probability of this positive gamma running into this sell pressure from the pension funds and creating a range, but the risk is to the upside. Length fading as spot moves higher should be freer to move to the upside. And then you combine that with the same thing we were talking about every day for months. We're in this insane uptrend in the market, and the trend is your friend. So don't be surprised if today's more of a range-bound day, but if we can really get above yesterday's highs for the indexes and for individual stocks, there's a possibility that we can really squeeze higher. And then what we wanted to pay attention to after the market opened was, where do we see relative strength and relative weakness? And that was the other big part, I think, of today's trading session, was recognizing that IWM relative strength early, and recognizing in the same breath the QQQ relative weakness. It was honestly, in some ways, easier to recognize the QQQ relative weakness this morning than it was the IWM strength. Just look at that chart. The IWM, moving higher in the first 5 minutes, and then kind of consolidating in a bullish manner for the first 30 minutes. And you got the Qs here just with almost momentum selling for the first 3 bars, getting into equilibrium, attempting to create a pivot. I think I called out a long in the Qs off the 940 bar low, just because that's where the market should pivot to see what kind of bounce we can get. That bounce was not great. A little bit of a bounce came in, and then that low broke. And once that low broke of that attempt of a bounce into that equilibrium area, the Qs were kind of just showing that they were shot. At a certain point here, we were looking for an extension bounce. I didn't like it on this first candle, but after this tail on the second candle, I remember someone at 10:10 asking me about Netflix. And I remember watching the Qs already attempting to snap up, but Netflix actually showing relative weakness on that bar, not being able to do it. And that's actually when the idea came to me of, okay, now maybe we can try the Qs long, because whoever was asking me about that, I was like, well, you definitely have the extension in Netflix, but I don't like the fact that it's back below 620, which is a key level for the stock. And I don't like the fact that the Qs are attempting to bounce instead of Netflix. So actually, now that I'm saying this, if you wanted to buy something, you're probably better off buying the Qs. And then that tail came in, and you got to snap back just 15-minute price correction basically. You got to snap back into the space between the 8 and 21 EMA. We did nothing all day, and then the Qs were able to stage a little bit of a rally into the close to be able to actually close green. Whereas the IWM is where that strength was. You had a little bit of a deeper pullback at 10 a.m. And I remember into this pullback saying, all right, the 10 a.m. high is key, right? Whenever we have one of these kind of breakdown candles, these negative Murabozu candles, what do I always say about this type of candlestick? This type of candlestick is what I call a penalty box candle. It doesn't mean that the IWM is not bullish. It just means that you should be a little bit cautious, viewed as like a yellow warning signal before you're coming back to the long side of the market. So you get this kind of penalty box candle is what I like to call it. That's why I stated if we can get back above the 10 a.m. high for the Russell, it'll start looking significantly more bullish. And then bam, look at this candle here. You get the inside 5 and up to break the 10 a.m. high. And once we broke that 10 a.m. high, by the time this candle closed here at 10:30, the Russell was looking fantastic. Spies were kind of doing nothing by that point. The Qs were a little bit weaker, but the Russell was looking fantastic by the time that 10:30 candle hit. And then it just maintained that relative strength with this great pattern of higher highs and higher lows all day. Whereas the Qs couldn't really seem to get out of their way. NVIDIA was weak, losing $900 at one point, though I see that it closed back above. AMD was actually kind of relatively strong. We talked about AMD as a either way trade off the inside day, but I didn't like it when that inside day actually broke to the downside. You had Apple super strong, which is interesting how often we're starting to see Apple trade the opposite of the Qs. So this one was actually the best long probably in tech world. We had discussed the inside and up off of yesterday's candle, even though this is technically a bearish pattern. The thing that we discussed in the morning meeting was that the stock actually held in very well in the face of negative news. And it's been a signal for as long as I've been trading that's worth paying attention to. That when a stock can hold in during negative news, it's something that you want to pay attention to because they don't care about that negative news in the same way anymore. There's buyers that are stepping in anyway because they think it's a value. The news is priced in whatever it is. The opposite is true also for really strong stocks. If something's been really strong and then positive news comes out that should make it go higher, but it can't, that's also something that you want to pay attention to because, well, why couldn't it? Why did it run into supply in the face of positive news? So not surprised at all to see this Apple as strong as it was. Best big cap tech stock out there. Inside day and up for Apple. Really, really nice. So, overall, it seemed like there was a lot of trading opportunity. I was frustrated by this iBio because my bid missed by a few pennies twice when I was trying to get stock. I had bid pre-market in 220-something that barely didn't get filled. Then I had a bid when this low came in at $2.26 and never got filled, which, I think led to a pretty decent move. That would have been a nice bid to get filled on. But it is what it is. You can't capture them all. Rock had a great call out with this QS when this volume came in here at 10:15 and it broke up. It was really interesting to see, as weak as the SPYs and the Qs were, obviously the IWM was stronger. But even before 10:30, when the IWM got out of the penalty box and was breaking higher, there were a lot of stocks out there that were just kind of ramping up. You could look at like a QS, or you could look at like a, I didn't see this candle in Wayfair is nasty. But Wayfair was trading really strong the first half hour of the day. Some of these solar names woke up for the first time in a while. I haven't even typed up Sunrun in what feels like ages, and one of you guys mentioned that it was strong, and I was like, oh, that's interesting. You had ENPH trading really well. So there were like interesting pockets of strength. There was a lot of dispersion today. I kind of like that because the dispersion actually leads to a lot of good trading opportunity even when our market is flatlined. So there was a lot of different stuff that you could focus on. It was a two-sided market. There was opportunity to make money in relatively weak names to the short side, though I think that the opportunity was easier buying relative strength to the long side. Yeah, First Solar, another solar name that was pretty solid today. So yeah, that's it. I love the IWM leadership. I love when we get some mean reversion where the IWM is strong compared to the Qs. And it's not like you got a breakdown on the Qs. It was just they didn't do anything today, and the IWM really broke out. This daily chart in the Russell looks great. We have a new closing high for the year. We're still above that 200, that weekly test of $200 that we had on the 19th, which we know is a huge weekly level, held, and now we're making new highs. Russell looks fantastic. I was a little bit nervous about these last couple candles, but obviously we totally countered them. And the Qs are actually still in their range, in that relative weakness, which I think is just fine. Let the Qs range out. Let NVIDIA do nothing but frustrate people. And let some of these other companies that haven't participated in the same way catch up a little bit. So, yeah, I think that's a synopsis of the day there. I don't really have anything specific as far as trading lessons off of today's action to kind of pull out of it. But if you guys have any questions, I'm, of course, happy to answer them. Not seeing anything in the VTF right now, so while you guys are thinking about what you want to say, I'll pop over to the YouTube. Gabriel asked me if I like XBI. I actually had XBI on my long list today for the first time in a while as a long above 94.50. The 94.50 to $95 range needs to break. And I think I mentioned in the morning meeting, I especially like it if it's happening with relative strength on the IWM. So yeah, XBI, I like it. I think it looks good. I like that it is now starting to break up off this base and break this kind of descending channel or descending triangle, which is technically a bullish pattern because it's been uptrending, to see if it can continue. And then you're also asking me about NXT. Next Tracker, I really don't know this company. I don't know anything about this thing, but the chart looks great. Big gap up here in February, creating a nice, bull flag over the course of a couple of months here. There's no extension. Your support's at 56. I would want to see it negate yesterday's candle, though, which you could do if today was an inside day. It's not. If it was an inside and up, I'd like that potentially for tomorrow to negate that candle for continuation. Back over to the VTF. I've got Vikas asking me about MDT, Medtronic. Something I haven't looked at for a long time. Super strong today. Was there news in this today? It looks like it's a news move based on the volume and everything else, but maybe it's not because, like I said, there were a lot of companies that were just really moving in their own world today and giving pretty big upside moves even when the market itself was weaker. But yeah, I think that this Medtronic looks great, especially after today's candle. Looks great as long as it holds above 86. I don't want to buy it tomorrow because I don't like chasing day twos, but if you can get some sort of bullish consolidation pattern or an inside and up pattern that develops over the course of the next couple of days, it could be pretty good. MDT, US FDA approves newest generation, whatever that is, system for treatment of symptomatic severe aortic stenosis. Eli asked me about Mara. So I traded a lot of Riot today, and it was disappointing, and it kind of ended up break even in it, basically. I really wanted to be in Riot because I liked this clean break of 1250, and the high of the day is 1249. I cheated on the breakout, and it never actually broke. So then I had to manage the position a little bit and ended up break even on it. I thought that looked pretty good with Bitcoin up this morning, but then Bitcoin totally fell back down, which it shouldn't have, by the way. Nice candle 2 trading sessions ago, inside day yesterday, and then this should have broken higher today. This is actually similar to what I would want to see, what I was just describing. Totally different, but an MDT. If you get an inside day today for rest, let these moving averages catch up a little bit further, and then look for like a 1, 2, 3 play for continuation the day after tomorrow, that's the type of trade that I really like. So yeah, Riot couldn't break out. It closed okay, but it was below 1250. Mara is very, very similar. Actually, I don't think that the pattern's as good in Mara, but Mara traded with a lot of relative strength compared to Riot. So usually, if I'm going to trade these, Mara is actually the one that I go after. But I liked the daily chart pattern better in Riot. And then, of course, when I was trading it, I was annoyed at myself because I was like, usually Mara is the leader. You want to be in the leader, not the laggard. But I liked the daily chart. And so here we are at the end of the day with Riot up 1.5% and Mara up 8.5%. If I traded Mara in the exact same way that I traded Riot, I would have had some pretty good P&L. Instead, with Riot, I made absolutely nothing. But you can just see what I'm talking about here with Riot. This very clean straight line resistance at 1250. The truth is, I hate all these companies. I really hate them. Big picture, but small picture, I'm a trader and I'm willing to make money on anything. So, you know, this thing wants to break higher and go, I'll be involved in it. And you know, my thought process is pretty much the same here on this Mara. It's got to get above and hold above this $22 area, which it started to do into the close today. So it looks decent. It looks decent for continuation, assuming that crypto holds up, which is not something I want to assume. Back over to YouTube from Romley. Hey, Dio. Kind of a basic question. Sorry, I'm still newer. That is no problem. We like beginner questions because most new traders are too nervous for whatever reason to ask them, and they should because it helps them. So I'm having trouble placing the $38 billion rebalance into context. A few weeks ago, you had talked about CTAs selling a certain amount into the down tape, and another lesser amount into an up tape. As basic as it sounds, is $38 billion a lot in the grand scheme of things? This is a great question. Really appreciate you asking it. I actually went over this real briefly in the morning meeting today, even though this is usually the type of stuff we do in the afternoon meeting, because your question is the right question. Well, what does $38 billion mean in the context of a market where you have individual companies that are worth trillions of dollars? And an interesting thing that I learned, you know, somewhat recently. So, you know, I don't know what the aggregate. If you took the S&P 500 and added up the market cap of all 500 companies, I have no idea how many trillions of dollars that totals, right? But what I can tell you is that it is trillions of dollars. But I can also tell you that it's not trillions of dollars that are coming into and out of the market every single day. It's billions of dollars. And the interesting thing, and this is somewhat of a more recent revelation for me on the more specifics with the numbers, I already kind of knew this conceptually. The interesting thing is how small of an amount of money it is that moves such a large amount of money. So what do I mean by that? So to give you your context, my understanding is that on average, it's about $50 billion worth of buying and selling in the marketplace every day that totals what actually moves the market. So if you think about that, it's $50 billion worth of buying and selling that actually moves trillions of dollars of market cap on a day-to-day basis. So that's the context that we want to think about. So if, you know, one day it's on average $50 billion that is moving the market, and then we have a pension rebalance selling that is $32 billion that's going to take place just over the course of a few days, all of a sudden that actually becomes a very significant number. So that I think is how you want to think about, you know, the influence that a pension rebalance selling can have, the influence that you're mentioning, the CTA systematic buying and selling that comes into the market, that we get updates on those numbers. That's how you want to think about it in terms of its context. So 38 billion, or I think it's actually 32 billion is what we discovered this morning, actually becomes, you know, very significant in that context. But like I was also pointing out earlier in the meeting, we've got $7 billion of positive gamma, which is a very big number, excuse me, which is a very big number. So what I don't know, and I don't know if anybody else here does, and maybe they can provide me some information so I can learn, Um, I don't know what $7 billion of positive gamma like actually turns into in terms of buying into certain degrees of down moves in the market. I know that has an insulating effect on the market, and I also know, just because I read the numbers a lot, that $7 billion is a high number relative to what it typically is. What is the number on average? I don't know what the average number is, but seeing the data kind of week in and week out, I'll be seeing, okay, we've got $1 billion of positive gamma, or a few $1 billion of positive gamma. I know that seven's a decent chunk. And that's exactly what that Goldman note was saying this morning, is that, yeah, we've got this big pension reselling, but that is going to sell right into this large amount of positive gamma, which should hold it up. And if anything, there's a risk to the upside that you could still squeeze higher, because that'll lift off a little bit on the upside. So you have a follow up here and another lesser amount into an update. Okay, no, it's the same question. Cool. So Rome, I hope that helps, and I really appreciate the question. It was a fantastic question. James wants to know what I think of the action in General Electric. Wow, this GE is a monster. General Electric is clearly the future. This is a sick move for GE. I haven't been following the story too much. Look at this breakout through this like 115 and how it's accelerated. Excuse me. Truthfully, I haven't been following the GE story very closely. It's just not a name that's on my list that I typically like to go after. I used to trade this stock actually a lot pre-split, when it was like a $10 stock. And once they split it, I've barely touched it ever since then. So I know that there has been an evolving news story around GE's business, but honestly, I kind of gloss over it, and there's only so many things my brain can handle, so I don't really remember what that is. I can comment on the price action. The price action looks fantastic. I feel like I'm looking at like a semiconductor name here. The way this GE has been moving, it's really, really impressive. This move from 130 to 180 here, this last $50. When's the last time that General Electric moved like this? The 90s or something? I really don't know. So yeah, I don't have a whole lot for you, because I don't really follow what the news update has been. The trend is your friend. You have a little bit of an acceleration today on that trend, so be careful if the stock goes parabolic. It's notable that there's an increase in volume on it. So at a certain point, maybe you're setting up for some sort of blow off top, upside capitulation, parabolic move, but you're not there yet. It's an accelerated trend that's still fully intact, and it accelerated a little bit through the acceleration today, if that makes sense. I know I just said that word like 3 times. I hope that helps, James. I apologize. That's all I got for you. Oh yeah, NXT is solar. I did, it's funny. I was just looking at like last night, like my P&L per symbol on stocks that I have traded. I think just this calendar year. I saw that NXT pop up, and I was trying to remember what that company was and when the heck I traded it. So you're right, I must have traded it at a certain point. Apex Joy. Does Amgen look like a king's bed bullish pattern? I've never heard of that pattern before. Where's Pat? Where's my charting pattern guru? Pat, you ever heard of a king's bed bullish pattern? New one for me. So I'm not familiar with the pattern. It's like I've never heard of it before. I still learn a new pattern occasionally. Pat taught me about the bullish taco burrito trade, or whatever the heck that one was called a couple of years ago. I actually don't even remember. A doji burrito. Yeah, so again, not familiar with the pattern, but I can analyze it as I see it. So Amgen here had really weakened out on February 7th. You had this fairly nasty descending channel here, but that broke up. It started to break up here on the 21st to the 25th, really these 3 trading sessions. So now you have a reversal, really. I could see, You've got a low. The problem is I'm trying to say if I think it's actually a reversal or not. It's a reversal if you want to count this low or this low as a pivot low, the 22nd or the 25th, because then you've got a low, a higher low, and a higher high. You really want to see this Amgen, I think, set up with another higher low pivot continuation hammer that you could try to go long versus. It looks significantly better now that it broke up out of this wedge, though. I can tell you that for sure. Back over to the VTF from Nick Stone. I had a trade I was wondering about after looking back through my journal on Monday the 25th. It's Monday this week. I shorted Apple 169.55. Monday the 25th. 169.55. Almost called. Next time you might as well just short the absolute low. I'm just kidding. I'm just messing with you. We've all been there. So you shorted at 169.55, a little after 940, even though it was very extended on the short-term chart, because it had broken what I thought was a support level and thought it might have a huge drop. Was this a horrible trade? Was I unlucky? I'd love to hear your thoughts. Sure. So 170, the first thing you want to know, it's a little bit sloppy of a level. It's really not a clean level. I actually think support's a little bit lower. I actually think that real support in Apple is closer to like this 167.50 to 165.50, that $2 range. That's what I had been looking for initially into this down move, and we never got it. I think that 170 is more of like a nice round whole number, so we like to look at it, than it is a major support level. A little bit of support, I guess, back here in May, but that was breached, more recently in September and October. So, the first thing I would note is it's not like a very clean straight line resistance level there at 170. So it's not necessarily going to bring in a whole ton of momentum of people who are out of the money necessarily on the break, though it is a round number. Regardless, let's assume for a minute that it is a great support level, which we could debate a little bit. I could see the argument that it is. I could make the argument that it isn't, or that it is, but it's a little bit sloppy. I don't hate your trade. You just got to realize the type of trade that you're taking. This is a pure momentum trade. So, the question is, how do you want to trade it? Do you want to just take this pure momentum trade through 170, in which case you want the price of 170, by the way. I don't like your execution of 169.55. If you think 170 is level, short 170. Don't short 169.55. Why do you want to be 45 cents late on your trade? And then if it's a pure momentum trade on a breakdown, you could use the high of the bar in which the break occurs. So the bar in which the break occurs, that high is 170.41. So if you shorted 170, even though it's extended, you're just taking it as a pure momentum trade. It's fine. It's early enough in the day where momentum trades can work. And you could use the high of that bar as a stop loss. So you have 42 cents risk. Or you could use the high of the day as your stop loss, in which case you'd have 70 cents worth of risk. But again, why is it a momentum trade? It's a momentum trade because the ADMA hasn't caught up to any of this yet. So that means that there is a high probability, a decently high probability, that your trade could shake you out and then still work, which frustrates me. But sometimes you got to just take the momentum trade. So I like the idea. I just don't like your execution. I don't know why you're waiting for the third bar here when it's 45 cents below the level to actually short. That doesn't feel like a momentum trade to me anymore. That starts to feel like you're just chasing price. You're like, oh, 170 broke, let me just short here. And then I don't know what you're using as a stop loss, because this is not an ignition bar. The second bar is an ignition bar. It's a breakdown candle. So you can use the high of that. There's good confirming volume on it. You can use the high of that. The third bar doesn't have that good confirming volume. It's not an ignition bar. So your only reference point now is the high of the day. So really now, I don't know what you use as your stop loss. Now instead of taking 70 cents risk versus the high of the day, or 40 cents risk versus the high of the ignition bar, you're 45 cents late, and you're have to use the high of the day as your stop. So now you're taking on, I don't know, $1.15 in risk. And now you got to ask yourself if that's what you're doing in order to trade this correctly, and you didn't tell me what your stop loss was, so I'm just assuming that you traded it correctly. If you're giving me any other answer as a stop loss, I'm going to argue that you didn't trade it correctly on that side of the trade either. But the next thing that I would argue is that if you are using the proper stop loss at that point, based on where you entered, which, look, there have been times where I missed the entry on a trade and I chase a little bit. Maybe that's what you're doing here. You miss the entry on the trade, it's going down, you chase a little bit, hopefully you don't do a lot of risk. If I do that, if I'm chasing price and I know that I'm chasing price, I make sure that I do it with a really small size because then I want to look for the opportunity to be able to get heavier if it gives me the opportunity. But really, more ideally, you just shorted from 170 to begin with. The low of the day here is 169.45. Depending on what you used as your stop loss, you got your risk covered or not. And that's really what you want. When you're taking a momentum trade, like when I bought QS today, that was a momentum trade. It was breaking through 6 when Rock called it out. I was like, all right, I'm going to buy some. I think I bought 6, maybe 601. And what I used as a stop loss, I used the low of the ignition bar as my stop loss. I used the 10:15 a.m. 5-minute candle low. My stop loss was $5.91, the low of the ignition bar. And all I wanted, I think I even said it out loud, I would just love to be able to get my risk covered on this momentum trade. And this is a momentum trade because it's a breakout ignition bar trade that I'm taking. But I love that it's a momentum trade where the ADMA actually also caught up to my stop loss. That's great. What I don't love necessarily is the time of the day. A little weird that stock's waking up at 10:15, but there were plenty of other growthy type of stocks that were running today, so I felt like it was kind of in good company and could continue anyway. But I was, not very comfortable with the trade, to be honest, and I really just wanted to get my risk covered. And I would not have chased this on this bar, which is kind of the equivalent of what you did with Apple. Meaning I would not have bought $6.12 here, because even though there's a volume uptick, maybe you could use this as a pivot low. Otherwise, you're all the way down here as the stop loss. So just using that as an analogy to try to help you to understand how breakouts and breakdowns occur and how you should probably trade them. Because again, if you traded this through the breakdown level with the stop at the ignition bar, you get your risk covered, and then you're holding it, you end up getting stopped out here at 10:55. If you traded it with the stop as the high of the day, which I would also consider doing, I don't think that that's wrong, and your price is 170, you have 70 cents worth of risk, you don't get your risk covered by just a little bit at that low, you end up getting stopped out, you take a loss. With you're taking a loss no matter what. You're chasing it. You have a really bad risk reward because you've got $1 plus worth of risk in Apple. I mean, think about what that means from a risk reward perspective. You need this thing to go. I mean, look, this could have broken down on that day and broken through support and worked its way to 165. You could have gotten $5 worth of reward out of the trade, which really would be 4.5 actually for you, but whatever. But even that, you're risking $1.15, you get $4.5 out of it. It's a very tough trade. So to directly answer your question, was this a horrible trade? No, I think it's a good trade. I think it was bad execution. Were you unlucky? I don't think that you were unlucky. I think you took a good trade and you had bad execution, and the good trade either failed entirely anyway or gave you the opportunity to get to break even depending on which stop loss you chose to use. So appreciate the question, Nick. If you think I was being hard on you, I hope you don't think that, because I really appreciate that you asked it, because you are going to improve because of that. I'm seeing some follow-up information from you. I was basing support off the low from the cluster of days following the gap up on 311. Right. Yeah, it's a little loose. It's this low here. 370.28. I could totally see it. Like I said, it's a little bit loose. I could totally see rounding the level to 170. So I don't dislike that nearly as much as like the trade execution and stop loss part of it. Thanks again for the question. From Kirill, 2 sessions in a row we have big moves in the last hour. This doesn't happen often. It happens. It definitely happens. We tend to get bigger moves in the beginning of the day and into the close. Most of the time when we get a big move in the close, it's going to be like MOC related, or In this case, I'm sure the imbalances are affecting the market a little bit. The rebalances, I should say, are affecting the market a little bit. So I don't think big moves in the close are rare. But these last two in a row after boring trading sessions are pretty decently significant. From Carol Spy, could make an all-time high tomorrow. It could. But if it gaps too much, it could be a better setup for a short. If it gets, let's say, 528, what are your thoughts? Yeah, by tomorrow, because that ADMA is going to catch up, I think that extreme extension in the SPY is where I'd be interested in shorting off that would be somewhere above 530. Because at this point, as of the close today, the ADMA is at 529.32. We have $4 worth of extension as of the close. The ADMA is going to be a little bit higher tomorrow, and it's only above $10. It's only at $10 or more of extension from the ADMA. Would I really become interested in coming in on the other side of that type of trade? We're not very extended on the daily chart at all. But yeah, let's take a quick look at the weekly. Weekly's got a bit of extension here. Doesn't seem like it's that extreme. It's interesting that the weekly hasn't touched the ADMA in a long time. Almost this entire year it hasn't actually touched the ADMA, but it's gotten pretty close. It's been riding up on it a little bit. But yeah, same deal. Kind of going. If you're looking to short a gap up or short tomorrow, if we gap and move higher, I only really would be interested somewhere about 530 at this point, 532 maybe. Cool. Popping back over to YouTube. Hey Derrick, question on trading ES today. Was long overnight from 52.86 quarter. From 52.86. We're long overnight from 52.86. Does my SPX chart line up with the ES chart? I would think that it would, but I don't have a lot of experience with that. I was hoping I could get a look at this, but it's never been up at that price, so it must not. Whatever. If I could look at the SPYs, I could look at SPX. I don't have the ES directly to look at it, so if you can tell me a time that you were originally long from. But whatever. So you're long overnight from whatever price, and you miss getting your risk covered at the opening high by $2.75, which is not very much for the ES. I got stopped out on the low today, and I re-entered at 52.77 around 1 p.m. for the re-entry. Do you think the re-entry is a good practice, or should I have given the original long more space? So I'm still a little tricky for me to answer the question, just because I'm not 100% sure on the original game plan. The 1 a.m. high last night, so I can't see that. I'm so glad I don't trade futures. The fact that you were up at 1 a.m. buying the ES, just, you know what, I was having like this great deep sleep, some incredible dreams about, trading stocks the next day and making money. Waking up at 1 a.m. to place a trade in the futures market sounds like my nightmare. So anyway, you're long from that price last night, and I can't see it on my charts because I don't have any price action charts from the middle of the night. But you end up getting stopped out. Where do you get stopped out? On the low today. I wonder why. Curious to know why you were using that low of the day. Why that price that happened to be the low of the day was your stop loss. But you had a game plan, obviously. You bought the stock, you put a stop loss in, your trade failed, and that was it. That was, you followed your game plan. Then you get back in at 1 p.m. Do I think that the reentry is a good practice? I'm going to say generally not. Generally, I think that you're going to be more likely to churn yourself than anything else. It's similar to what I was talking about with Tesla yesterday. If you caught yesterday's afternoon meeting, if you didn't, it might be worth going back and rewatching the video from when I was talking about my own emotions and thought processes when I got stopped out of Tesla pretty much at the high of this candle, and then it immediately dropped $2 after, and I'm literally the high tick on that. And I saw it going back down, and there's definitely a time in my career where, and maybe even sometimes I still can make this mistake, where I would have been so pissed here that I got stopped at the high tick that I would have been reshorting somewhere on the way down, re-entering the position. And what tends to happen more times than not is that you just churn yourself. So what I said yesterday was if I re-entered at 162, I don't think I would have even got my risk covered, and then I would have gotten stopped out at the new high, and I would have lost an extra $1.30, and I would have, turned this thing into like what was starting to become a nice loser at that point, which it shouldn't be considering that I was up decent money at a certain point. I don't like the re-entries. More times than not, I think you end up churning yourself and costing yourself more money than if you were just giving it more space to begin with. But big asterisks on giving it more space to begin with, you got to make sure that you're using the right stop loss. You can't just give things space for the sake of space. For every time I think that you get shaken out of something at a high like I did with Tesla, or at a low like you did with the S&P, and it is a true shakeout and then it goes in the other direction, for every time that happens, I think that there's going to be another 10 plus times where you got stopped out for a real reason, and if you re-enter, it's just going to mean that you're going to lose more money. And that would have been my experience with Tesla had I done it yesterday. I know that's not your experience with the S&P with your re-entry today because it went up from that point. But I don't like the idea. I think that you only get back into trades or names when there's an entirely new setup that actually comes into play. So that'd be my feedback for you. 2 candles closed below the 200 moving average on a 1-hour chart. Okay. And that's something I really look at. So thanks, Alan. I hope that helps. James back on GE, that you've been trading it, sounds like successfully, but you keep closing your trades early and leaving some on the table. This is also so important for everybody because I'm glad you mentioned that with your follow-up comment. Thanks, Tate. Tate posted the ES chart for me from the middle of the night so I can see it, but I kind of want to move on from the question now. I see it. Anyway, on to GE again for James, mentioning that he's getting out of positions, too early and leaving some money on the table. Reward maximization strategies, guys, are so important for maximizing the risk reward on the trades that you're putting in and for maximizing your success as a trader. It's really, really important that you learn to be able to build that into your game plan for a certain percent of your position to let it ride. Just using this as a random example, there's a breakout here at $132.50 that took place on January 30th. If you bought that breakout, let's just say, there is no reason why you still can't have even 10% of your position, $50 in the money right now. And that's where the big money I truly think comes from. The big money is from capturing big moves, ideally on big size. Can't always be perfect on either side of that, especially the big size, because you've got to liquidate some of your position to cover your risk. You're probably trailing on multiple time frames. But at the end of that day, on March 30th, it's a breakout trade. It's a trend continuation trade. You could have kept anywhere from 25 to 50% of your position, and there's no reason why you can't still have 10 to 25% of the position left of that original buy, $50 in the money. And now ask yourself, how often do you need that winner? How often do you need, I don't know what the risk was on GE intraday that day, and I can't go back to a 5-minute chart and look at what it looked like specifically when it broke 132.50, but it could have been 20 cents worth of risk, 25 cents worth, reasonably 25 cents worth of risk. It's a $131 stock. It's a little bit expensive, but tends to be a thicker name. I think let's assume 25 cents worth of risk. I think it's realistic. How often do you need to risk 25 cents on a trade and still have 10 to 25% of your position, $50 in the money, to make a living out of this business? Not that many. That counters so many failed trades. So it all comes back to like these same fundamental keys to success with trading. It's risk management, it's reward maximization, it's execution, it's game planning. It goes back to Nick's question on Apple with execution. It goes back to your comments here on reward maximization. It goes back to what we always talk about limiting the downside, never allowing yourself to lose more than a certain amount in a given day, a certain amount on a series of trades that compose a given day, or on a trade-by-trade basis over a given day. Never allowing yourself to lose more than that. And then allowing yourself to make significantly more than that when trades work out. It's very often, I can almost always, if a trader reaches out to me and says, hey, I'm struggling, and you don't even need to say anything else. Just say, hey, I'm struggling. And then if I can look at your account over the course of the last 3 months, it probably will take me about a minute and a half to know exactly what the problem is, because it's the same problem same couple problems for almost everybody. Either, and again, we can just use simple numbers here again. You're never supposed to lose more than $500 in a day, but I look at your account over the course of the last 3 months, and hey, here you lost 800, here you lost 1,200, here you lost 1,700 on just, you throw in one of those days a month where you lost significantly more than that max loss. Now I know why you're not making money. Because that in and of itself, if you should never lose more than $500 in a day, and you have one day in a month where you lose $2,000, you're probably not making money that month. Probably not. And then the other thing is the flip side. So issue number 2. I look at your account over the course of the last 3 months. You're never supposed to lose more than $500 in a day. That's the first thing I'm going to look for. I'm going to quickly comb through all the negative days. And now, boom, not a single day you've lost more than $500. Great. I love that. The risk management's in check. It's the hardest part of the battle. You're never losing more than $500. Next, now I'm going to look at the upside. I'm never seeing any days where the trader's making more than $200 to $500. Well, bam, there's the problem. This trader has the discipline on the risk side, but doesn't have the game planning in place for reward maximization that's necessary, that's going to make him money. Why? Because that trader took GE breakout at 132.50 and was out by 134. When the trade trend from a swing trading perspective, if you kept even 25% or less of the position, has now worked for $50. How often do you need this, right? If you can be disciplined on that downside and never lose more than $500 a day, and most trading sessions, and this is the hard part for us psychologically, because we're sitting here, I should say, looking at our screens, looking at the numbers all day. When you're in the process of trading, every single trade that you're in always feels like it's this do or die trade that you got to make money in or not. That's how I felt when I got stopped at a Tesla yesterday. Oh my God, I can't believe I got stopped at a Tesla. I was in the money so much in this thing. I had it from, originally 174. I had it $14 in the money. I traded it really well. I booked profit on the way down. I reshorted in certain areas on the way up. I managed to not get stopped out. I was able to cover more stock again. And now, oh my God, bad news came out. I really don't want to get stopped out of it. I think Tesla belongs at $70. I can't believe I'm getting stopped out over this BS news that came out of Italy. The Italian government's going to buy cyber trucks. Who cares? How's that going to stop the stock from going down to $70? This piece of crap stock. That's how I feel in the moment. This is the most important trade to me in the world, because it's the trade that I'm in right now. I believe in my idea, and I don't want to get stopped out. But most trading days in a given month are gravy. Most trading days, if you've got good risk management and you're putting on good trades and you're covering your risk, most days in a month you're going to not, lose your max loss or more than your max loss. You're not going to gain 5x your max loss on the upside. Most days, if your max loss is $500, then maybe you end the day between 300 down and 300 up, or 500 down and 700 up, or something like that. So I'm telling you, most days are gravy. So that means that don't get married to a trade like I wanted to a Tesla, even though that's what our psychology does. Don't re-enter a trade without a new setup to, add on to that loss. Stop yourself out of the trades when they don't work. Stop yourself out on the downside when you hit your max loss. But also, don't get out of the trade when it's working because you see some green on the screen. Because even though most of those days are going to be gravy, you need to occasionally be able to have this trade. And that's what I'm saying. How often do you need to have the trade where you buy the breakout at 132.50 and then you're $50 in the money on 25% of a position? So, I don't know, if you risk $500 in a given day, maybe you risked $150 in this trade. If you risked $150 in this trade, we're saying it's 25 cents worth of risk. What does that give you? It gives you 600 shares. So you have 600 shares. You take off 300 shares to cover your risk. You end up taking off 100 or 200 more shares of the 300 that you have remaining at certain points on the way up. And now you have 100 or 200 shares left that you're just trailing on the daily chart, because that's what reward maximization requires, trailing. That's what we talk about in the game planning class that all of my traders should have access to, where we're talking about game planning for reward maximization. You take that last bit of stock and you say, you know what, I'm in this. I'm going to let it run as much as it wants to run, and I will just keep raising my stop to pivot lows when the ADMA catches up and then new highs come in. So now on that last 100 or 200 shares, eventually you raise your stop to the low from the 21st. When do you do that? You probably do that on the 23rd. Then eventually you raise your stop to the low here from the 27th. When do you do that? You're probably doing that on like the 29th when the ADMA catches up and the new high comes in. Eventually you raise your stop to the low from the 5th. When do you do that? You raise your stop to the low from the 5th, probably on the 7th, when the ADMA is caught up and a new high comes in. Then eventually you raise your stop maybe to the low of the 11th or the low of the 15th. When do you do that? When the new high comes in and the ADMA is caught up to the pivot. And now after today, you can raise your stop to the low from yesterday, which is 172.38. So at a minimum, if this stock fails tomorrow, you're getting stopped out where you make $40 on the trade. $40 per 100 shares, and we're saying you've got 1 to 200 shares left. That's $4,000 to $8,000. Yeah, I'm talking about a trade where you risked $150 in it. I'm talking about like the numbers here for some of the smallest traders on the entire team, that this is something that you could have done reasonably. And now you just made $4,000 to $8,000 on a trade. Now let's circle back to your month of March, right? Or your month of February/March, because it's been a swing trade here. Every single day, you're a disciplined trader. You never let yourself lose more than $500 in a given day. You throw in, I don't know, over the course of 20 trading sessions, 4 or 5 days where you hit your max loss. Hopefully it's less than that, but 4 or 5 days where you hit your max loss. So that's $2,000, let's say, of downside losses. And then obviously you're having days where you're making $300, $500, whatever. Let's say that every single other thing that you did was like kind of gravy over the course of these last 2 months. I'm probably looking at a trader who is a very small trader with a small account, who's only risking $500 in a day, who's only risking $150 in a trade, who is making $4,000 a month. That's like a good start for a newer, smaller trader who is building up their account and improving their trading. That's all this game comes down to, that needs to be the focus of every trader. And again, I know it's so hard at the moment because it's technical analysis and it's psychology, and I'm subject to that psychology too, especially when you think about like the Tesla trade from yesterday that I'm describing my emotions in and how I felt. But just do the right things consistently over time, and that's how you make money in this business. And that's what I always remind myself when I'm struggling with that Tesla stop loss or whatever. All I got to do is the right things over time, and I will make money. What are the right things? Stop yourself out of your trades when they don't work. Stop yourself out when you're at your max loss for the day. Have a game plan in place for reward maximization so that you can actually make money. So really appreciate that you put in that comment there in there, James, in the YouTube. Awesome, Mike. Cool. All right. From Eli on Ford. Oh, wow. Ford got back to 13 today. I had Ford on the radar for 13 yesterday, and it never triggered. I took it off my radar because it was that gross negative Mariposa. They 100% negated that today, and it's back at 13. Ford looks great. It's just a really slow, boring stock. But this thing looks great above 13. We can reanalyze it in the morning meeting. Have a great night, everybody. I'll see you tomorrow. From Nick, something to add as well, which is difficult in the beginning, is recognizing when the stars align for an A++ setup. That's when you apply the buying power and risk. Yeah, 100%, 100%. We can jump into that one at some point soon too. From Ryan with sneaking in another question. When thinking about max loss for the day, how do you manage open P&L versus new trades? Are we just talking about new trades? Yeah, so that's another really good question. The quick answer on that is that you have to have a little bit of balance. You have to have a little bit of a balance, and this is where it kind of gets a bit more nuanced. So it's primarily should be new trades on the day, but you have to recognize with the open P&L that you have, if that had where each trade is that you are already in that trade, meaning is this like if you're in GE, just to use that as an example, and it stops you out tomorrow at 172.38, you'll have given back $7 or so. So $700. So let's say it's 100 shares. Let's say your max loss is $500. You're going to give back $700. That shouldn't affect your stop loss for that day, though. So you have to recognize, all right, this is a trade that's a win-win situation. I'm going to make money no matter what. I'm not going to let that impact my new trading for the day. If it's a little bit of a different situation where there's a potential for the stock to actually still give you some sort of realized loss, then you need to actually figure out a way to be able to add that into your max loss for that day. But yeah, it's primarily going to be about new trades that you're entering, because for the most part, you shouldn't be swinging things unless you're in the win-win situation to begin with. Cool. All right, so I'm going to end it there. If you're watching on YouTube, give me the thumbs up. Have a great night, everybody. See you tomorrow.